I'm very pleased to be able to speak with Chris Skinner, founder of the Financial Services Club in Europe and writer of two books, the later Value Web and the first The Digital Bank, purveyor of all that is happening in the fintech space around the world, and a very good friend over the many years, and I've seen how you've evolved, and very good friends with others in our midst, who've also made a name for themselves. As you collect all of that insight in terms of who's doing what in the fintech space, payments, data analytics, peer-to-peer, and all the other aspects, what would you say is the general trend that is taking place that banks need to be most afraid of?
I don't think banks need to be afraid of anything in terms of fintech and technology and change. I think they probably do fear change because no one likes their cheese to be moved, and that's really where they have to wake up, because there's a lot of things happening, there's a lot of movement taking place very quickly in the markets with technology in the fintech space. A lot of new companies growing into billion-dollar plus companies almost overnight. A lot of these companies are only 3 or 4 or 5 years old. So really it's being aware of what those companies are doing, where they're playing, and what impact that has on the core banking business. And for a lot of this, the impact is actually negligible. It's on the periphery of the business. And I think if any of this really starts to get to the core of the business, then they're likely to be acquisition targets.
But we're now having this chat at a time when banks have woken up. It is a boardroom level discussion. Your books are selling well. Are banks now, is the empire striking back? And are banks trying to wrap themselves around this nascent development in a way that potentially could reshape it into the image of the banks themselves? In other words, they're not really going to be disintermediated. The game plan is still up in the air.
Well, for a lot of banks, the issue is actually leadership. It's all about changing the culture of the bank and getting the culture of the bank to reflect a technology-led operation and organisation. And most banks don't have technologists in their decision-making boardroom. They have accountants and risk managers and compliance people. They don't actually have people who understand technology and technology leadership. And so there's only a few banks out there that I talk about that are really pushing the envelope. Quite a lot actually from Asia, and in particular China, because you've got Alibaba and Tencent with WeBank and Yes Bank doing some interesting things in particular. But equally, banks like DBS are pretty much at the forefront because they are investing in technology-led change. Banks like BBVA, which happens to have a programmer as their chairman, Francisco Gonzalez, are leading technology-led change. So it's technology-led change in banking that's the challenge, and about 2/5 of banks don't have the technology leadership to do that change.
Let's take a little bit about where banks actually are today, and what are the inflection points that are you looking at? At which point do you think that real change starts to take place? Peer-to-peer lending, at which point does it become a phenomenon, or is it already a phenomenon, and that it's going to either coexist with the banks, or banks have to figure out a way to onboard this way of doing business that's going to transform what they look like?
If you look at peer-to-peer lending as a good example, most of the peer-to-peer lending in America is actually institution to individual lending, because they source most of their funds from the institutional investment markets rather than from individuals, which is the true peer-to-peer model. Having said that, you're now seeing the American lenders becoming quite mature. So you've got Lending Club that's gone through an IPO, is a publicly listed company that has a partnership with Alibaba, for example. So if American small businesses are sourcing components from China, they can just click a button on Alibaba and not even realize they're getting that loan from Lending Club. That's a maturing model, but it's actually on the periphery of where banks focus. Banks are not focused upon small business lending or student loans, which is where a lot of the lenders in the US have grown up in this peer-to-peer marketplace. I was just going to say, in UK it's rather different, because when you say a phenomena, UK is now seeing a doubling year on year in the amount of funding that's going through peer-to-peer lenders. And so they're taking about 4% of the credit marketplace in the UK last year, which they're only 10 years old. But if it's 8% next year, it starts to get interesting.
But what we're learning from the UK is that on the credit scoring, on the credit profiling model, and on the pricing, they're actually not very much different from banks. It's almost like a proof of concept stage at the, still.
To an extent. I mean, Zopa is a leading peer-to-peer lender in the UK, and they've had a very risk-averse strategy. In fact, they themselves said that for the first couple of years they were turning down loans that banks would have accepted because their risk models were so extreme. But what they've now done is they've got a behavioural risk analysis model that they've grown in-house. So rather than just using Experian or FICO scores, credit scores, they're using behavioural models to risk assess who they lend to or enable lending to. And their rates are slightly better than banks. As you say, they're not massively different, but they're better.
So what seems to be evolving, or where we are in the evolution, is that proof of concept is the technology, it's the robustness of the infrastructure behind it, but on the front end, really, it's more of the same, as it were. It's just different ways to eat a pizza.
Yes and no. I mean, the fundamental difference between Zopa and the banks is that Zopa's doing lending through software and servers. And so all the analysis and all the risk modelling is in the software and servers. Therefore, there's no humans involved in the process. And equally, the bank structure that's the typical bank credit risk model isn't the same in Zopa as it is in a bank. So they would claim, and I agree with them, that they've got a very different business model to a traditional bank model. Having said that, if you look at a lot of the other sort of growing capabilities, it's sitting on top of the bank system. A lot of the payment stuff, it sits on top of Visa, MasterCard and the SWIFT and bank system. It's not replacing it with a different system.
Yeah. So it's still work in progress in that way. Your book, Value Web, is fascinating because you are suggesting that that the business that banks are in is the same business, that should be the same business that fintech companies are in, or anyone playing in the internet space, is that they have to capture value or demonstrate value or create value. And that value is not necessarily the commodity in which they are trading in. So it's not the money, it's not the merchandising, it's the trust, it's the dependency in that way. Would I be correct to tell us what you mean by value?
Well, the two books go together to a large extent, in that Digital Bank was all about how to convert a bank to be a digital bank rather than a physical bank. And the reason why that's important is that we've moved from the physical distribution of paper through buildings and humans in branch networks to the digital distribution of data through software and servers on the internet, on a globalized network. And that demands a completely different thinking as the foundation of banks, because banks are just data anyway. That's what they're dealing with, bits and bytes of information about value. And then Value Web is saying that when you look at the fintech community, they're creating a new internet of value, such that we can exchange value in any form. It could be currency, but equally it could be ideas, or it could be air miles, it could be anything we think of as being valuable. And by using the technologies of embedded chips in everything and shared ledgers on the blockchain, you can do that exchange of value, store of value, for near enough free, and immediately transfer that information and value between each other. So on a globalized basis, I can exchange value immediately and for almost nothing. And historically, with the banking system, it's taken days to do this. I got a payment, for example, last year from Brazil. It took 20 days to get through to my account. I got a check from America last year. It took 31 days to be credited to my account. It cost me $100 to get processed. This should be free. It should be immediate. It shouldn't cost $100. It shouldn't take a month. Well,
if the asymmetry of information, the asymmetry of infrastructure is where banks make money from today. And if you say value is where it's something that the customer values, and you say that it should be for free, so therefore what's the business proposition for the bank or for the intermediary?
Well, I think banks have to think of the future as being one where their traditional products make no money, make no profit. And that's exactly what the peer-to-peer lenders are doing with the credit marketplace. They're squeezing the margins and saying, as a bank, you can't compete with this unless you are a digital bank. And even then, you're not going to make much money out of your traditional lending structures and products. So you've got to make money in other ways. And it's providing far more value about the information that the customer is getting about their currency, money, exchanges.
You're going to be creating all that value, all that transparency, all that information, all that empowerment. But where's the business? Where's the money?
You make money out of providing more knowledge about money. So a good example is, Bank of America teaming up with Cardlytics to actually offer coupons and vouchers at the point of relevance, rather than just being a coupon in the post. So you actually get the coupon alerted to you as you're walking past the store, or as you're about to order goods on the internet, saying you've got this loyalty voucher which you can use for that purchase on the internet you're about to make. It's having far more contextual knowledge about the customer and far more analytics about who they are, what they're doing, and personalising every transaction, and also providing predictive, proactive services around that information so that I can actually get something given to me before I think I need it.
Just taking that example of having a check take 31 days to clear from the US to the UK, take that and put that on blockchain. That's the big topic that everyone's talking about. Everyone refers to blockchain like they're talking about Godot. And everyone thinks they've seen Godot, they think they know who Godot is, but nobody's ever really described him or put his hands on him. A question I love asking is, what programming language is blockchain programmed on today? And absolutely nobody's ever been able to tell me. So someone's doing the programming work, and it'd be nice to know what's the real life or real world description that they're working on. There is this fear that when a lot of people talk about blockchain, they only mean taking that check processing that you talked about and putting it on a distributed ledger, which means that all of the parties in the transaction get to see each other's ledgers or share that ledger, and therefore have that whole transaction processed immediately, transparently, so-called what used to be called straight-through processing in a way. Is that the correct layman's understanding, or is there something fundamentally different about blockchain and how we should work with it?
I think there's something fundamentally different about blockchain in terms of what Satoshi Nakamoto launched to the world in 2009 when the Bitcoin white paper was released, is the ability to transfer anything of value between anybody and record it irrefutably as proof on the internet. And then the programming languages are people taking that protocol of the blockchain technology and developing it into different services. So you now have lots and lots of startup companies, hundreds of them, developing blockchain-based capabilities for the recording of diamonds, for example, and the identification of diamonds as they move around the world, which is a company called Everledger. You've got companies like Ethereum and Stellar and Ripple all creating shared ledgers for the backbone of bank systems. You've got R3 creating a new Swift-style shared ledger-based system on the blockchain for global clearing and settlement. You've got a lot of clearing and settlement companies growing, like Digital Asset Holdings, Epiphyte, Colu, the list goes on. Hundreds of companies developing specific things in banking and financial services, as well as generic things in other areas. And, the UK government, for example, just came out with a paper from the chief scientific officer saying we should use shared ledgers, blockchain, for the issuance of passports, for tax collections, for benefits distribution, for mortgage transfer, house sales, you name it. This is a technology you can use for that capability. And the real reason why it's so important, because it's rebuilding everything, is that the protocol gives you an irrefutable proof of the existence of something, or the value of something, or the store of that value of something, which can therefore be developed as an internet-based proof for any illustration of where you need to record the exchange or the store of value. And that's why it's so important.
What's interesting about this so-called protocol of blockchain is that it doesn't yet exist. There's a protocol for the internet, TCP/IP. There's a protocol for Bitcoin, and that's what makes it successful. But all of the players entering into developing blockchain models, would like to corner this protocol definition.
Yeah.
Even the agreed community doesn't exist just now.
Yeah.
So a lot of the work is still very much in early days.
Yeah.
And that is why I fear that a lot of the work is nothing more than automating what exists, in straight-through processing today.
No, I mean, with R3, you've got 42 banks investing in this consortia of knowledge proof of concept using blockchain technologies. You've got 11 that have now committed to using Microsoft Azure and Ethereum through R3 for developing a clearing and settlement system between global banks. You've got
all in a closed environment, and isn't
that's what you call a shared ledger. It's shared between that closed environment. Eventually, that shared ledger might become an environment used by all the banks. That's what SWIFT is. It's just a shared ledger, but it happens to be one built on old technologies. But it's shared by all the banks of the world as a global messaging network, transaction network.
And so how should the institution be configured around this way of thinking about sharing ledgers?
Well, to a large extent, it's saying, do you want to get experience and knowledge about this capability early, or do you want to wait until someone's developed it and you just have to take what they've developed? Now, the banks at the moment that are leading in this development of blockchain-based shared ledgers for financial services are banks like UBS, JP Morgan, Commonwealth Bank of Australia, a number that are investing in these key startups like R3, like Digital Asset Holdings, which has 13 banks investing $52 million in their last round of funding. You've got a lot of developments like UBS with Clearmatics developing clearing and settlement blockchain-based capabilities. And if you just want to wait until they've developed it and then you're forced to use what they've developed, then you can sit back and ignore this. Otherwise, you might say, actually, I think we should be in a leadership role here as well. We should be investing in getting into this space early. Maybe we should be leading this space. Well,
in all the examples that you've mentioned, they're about trading rather than banking. The trading assets of banks, and actually between banks. So, and that's actually an issue in itself, which is so much of what banks do is between themselves rather than with the customer.
Well, you've got companies like Wave and Tradle that are doing trade finance, supply chain asset tracking. You've got a number of launches like Circle that's offering consumer-based, Bitcoin-based wallets that can store any currency as well as Bitcoin as a currency. So there's, across the whole raft of banking, retail, commercial, investment banking, we're seeing proof of concepts experiments that are blockchain-based, that are some Bitcoin blockchain-based, some not Bitcoin blockchain-based. We're yet to see one become a winner, and that's the real question, which one's going to be the winners in these key spaces? And once they've become a winner, are you actually going to be part of understanding and using their network, or are you excluded?
Well, that suggests a world where proprietary networks continue to dominate, and assuming that banking continues to be a privileged business, highly regulated and so on. But that's not what blockchain offers, and that's not what...
Well, it offers the other side as well, which is the anarchy of the internet, if you want, which is completely unregulated and unbanked. Some people want to use that, but I personally find that area a little bit unnerving, because I've lost money on Mt. Gox, for example, as did many. And so do you want to be in a completely unregulated market where your value store might be lost overnight, or would you rather be in one that's actually banked and trusted with licenses?
Coming back to your issue of value creation and what banks or businesses in general should think about as value, where do you think the non-banks are heading now? Facebook, Twitter, and even the traditional payment networks like PayPal, for example. PayPal is simplistic in that at the back end it's still banking in that regard. And in China, you have now the on Weixin or WeChat, you can actually do transactions immediately, instantly, and it also has a store of value, which means that you can use it as a purse. Are these developments going to disintermediate banks? Are they developments that banks should take on board? And if they do, how's the creation of new value going to be like? Because their fundamental business is something else. It's messaging. It's texting and so on. And the basic business of banking is something else. Where's the collaboration point? Or is that war all out?
Yeah, I mean, we're going to see some hybrid models emerging where banks will be integrated into other services, and I think Facebook is a good example of that, where Facebook is going to have a buy button in their messenger app. The buy button will be still going through a bank at the back end though, because they're not going to launch a bank. Having said that, they could. And that's why everyone's watching Alibaba and Tencent and saying, is the WeBank and Yes Bank going to be something that's going to become mainstream in China, or is it just going to stay in a particular area, limited by regulation to not competing with mainstream banks? And that tends to be the sort of model that I think everyone's wondering how it's going to play out, but not just in China, but in the US with Google, Amazon, Facebook. Are they going to move into mainstream banking? I don't think so. Are they going to squeeze bank margins by layering on top a lot of frictionless services like the PayPal's did for internet payments? When you get Facebook buy buttons, when you've got Amazon coins, when you've got Google checkout that's as easy as using the Amazon checkout and can be plugged and played into anywhere, where's the bank's brand going to be? And that's really the key question, I think, that the bank's brand becomes a back end and the consumer sees at the front end other services. Do they still consider the bank's brand to be important to them? No, because the bank's just a service that's plugged and played into everything else. And to a large extent, that's, I think, where we're heading, that we're seeing the open sourcing of finance, and banks become a group of APIs. Anybody can plug into anything. And for the customer, they just want to know that they can trust their money will not be lost. And at the moment, the best way to have that trust in terms of value store is in a bank, because it's regulated.
Assuming you're writing your next book, or you will eventually, what are some of the sketches that you've started taking into account?
I just finished this one, Emmanuel. I'd say I think these two books kind of go together. So what I'll probably look at next is what's going to be the next generation of technologies that will change maybe the internet or banking. And what we're really seeing now is a lot of discussions around data analytics and the ability to use artificial intelligence and deep learning to start doing interesting new things. We're seeing this emerging already with things like DBS and UBS, who are both using IBM's Watson for deep data analytics on wealth management portfolios. But I think we'll start to see a lot more deep learning coming out of Google and Amazon and Alibaba and others that banks will start to incorporate into their operations for this predictive analytics that I referenced earlier, this contextual knowledge of the customer. And the idea that rather than having to program knowledge about customer into transactions, the system learns your transactions and behaviours and starts to proactively inform the customer on a one-to-one basis without the system having to program.
Do concepts like robo-advisors excite you, or do you think that it's got some way to go? And the reason I ask this, what you meant by predictive analytics is that it's the learning aspect of machines. Or software, and we accede to robo advisors because we just assume that they'll take into account every possible knowable information and then process it for the customer, and that hopefully they will learn as well. I mean, is that something that you buy into? Do you think it's a possibility?
I think we're still in very early days. I mean, the robo-advisors out there at the moment, like the Betterments and the Personal Capitals of this world, are still having a lot of human interaction behind them. The deep learning capability is not yet even really tried and tested. It's going to be another decade before we really start to see this come into mainstream usage in finance. And the deep learning that I'm getting at means that you wouldn't have human wealth management advisors in any form being required, because the system's automating and learning itself and can provide automated, therefore, wealth management as part of its deep learning without any human mind or hand involved. And that is a long way away. That's at least 10 years away before we get to that stage. But the robo-advisors we see today are interesting. They don't excite me that much because I think we're going to see something massively different in a decade.
Chris, really good to speak to you. And, we've been friends for such a long time. I'm sure that we will continue to banter a lot about where all this is going. Thank you very much.
Cheers, Emmanuel, and you take care too.